All right, today we're tearing into CNH Industrial. We've got a deep dive analysis from a value investor, and we're going to figure out, is this thing a hidden gem or is it a value trap just waiting to happen? So let's just cut straight to the chase. Here's the big question this whole analysis is trying to answer. If you're an investor and you want a solid 9% return every year, is CNH Industrial the stock that's going to get you there? Let's find out. So here's what we're going to do. We're going to break down this investor's entire thought process. We'll look at the numbers they used, the logic behind it, and of course, their final call on the stock. We're going to see exactly how they got from A to Z. All right, first things first, the big one. What is this company actually worth? Let's talk valuation. So, who exactly is CNH Industrial? Well, you've probably seen their stuff around. We're talking about brands like Case IH Tractors, New Holland Construction Equipment. You know, the big leagues. They make the heavy machinery for farming and building all over the world. But here's the kicker, and this is super important. Their business is what we call cyclical. That means its success rides the waves of the economy. When things are good, they do great. When things are bad, not so much. Okay, now for the fun part, the numbers. How did this analyst figure out the company's true value? Well, they used a two-pronged attack. First up, the discounted cash flow, or DCF. Fancy name, but all it really means is they're estimating all the cash the company's going to make in the future and calculating what that's worth today. That method spits out a value of $11.20. The second angle, a multiple-based value. This is where they compare CNH to its competitors, which gives them $9.80. Then they just kind of blend those two numbers together to get one final intrinsic value. And, drumroll please, that blended number comes out to $10.50. Now, look at the current stock price, $10.64. See that? They're practically the same. This is a huge deal. It means the price you'd pay on the market today is pretty much exactly what the analyst thinks it's worth. There's no discount, no margin of safety, as investors like to call it. So that begs the question, right? Why is it valued like this? To answer that, we've got to go deeper. It's time to get into the nuts and bolts of the company's financial health and see what's really going on under the hood. Okay, before we go any further, I just want you to look at this number. Just let it sink in. $27 billion. And no, that's not their sales. That's not what the company's worth. That, my friends, is the mountain of debt CNH is sitting on. And that massive number really shines a spotlight on the main problems here. I mean, it translates to a debt-to-equity ratio of 346%. That's a lot. On top of that, the company isn't all that profitable. Its return on equity is just over 6%. And to make things worse, its earnings are all over the place. In fact, they just dropped by half year over year. Yeah, not exactly a rosy picture. Okay, so what about its brand power? Its moat, the thing that protects it from competitors. Well, the analyst says it's moderate. They've got good brands, a solid dealer network, but this quote just says it all. The moat is not impregnable. You've got giants like Deere out there with more pricing power and better tech. That puts CNH in a really tough spot. So with all those challenges in mind, what could the future look like for CNH? Let's shift gears and look at the possibilities, the good, the bad, and everything in between. To get a handle on this, the analyst did what's called a weighted SWOT analysis. Basically, they scored the company's strengths, weaknesses, opportunities, and threats. And the final score, a 5.25 out of 10. What does that tell us? It says CNH is stable. They're holding their own, but they're not exactly set up to blow the competition out of the water anytime soon. And this is where things get really interesting, the scenario analysis. Check this out. If we hit a recession, the bear case, the stock's value might sink to $7.50. The base case, which is kind of business as usual, is that $10.50 number we already saw. But if the economy booms, the bull case, the value could jump all the way up to $14. This just hammers home how much this company's fortunes are tied to the economy. This chart right here just paints the perfect picture. Look at that. The risk score is 6.4 and the opportunity score is 6.2. They are practically tied. It just reinforces that whole idea we've been talking about. CNH isn't some crazy bargain, but it's not wildly overpriced either. It's just right there in the middle. Which brings us back to the most important question of all, right? For our investor who wants that 9% return, what's the magic number? What's the right price to pay? Now, this is where the strategy comes in. If you want that 9%, when you buy is everything. Look here. If you're only holding for 5 years, you could pay up to $9. But if you're in it for the long haul, say 16 years, you've got to buy it for way less, around $7.20, to have a shot at hitting that goal. And that is the absolute key takeaway. For that long-term, 16-year goal, the buy price has to be around $7.20. Think about that. The stock is over $10.50 right now. That's a huge gap. It basically means you have to sit on your hands and wait for a pretty big market drop before you can even think about buying in. Okay, let's put it all together. We've looked at the valuation, the messy financials, and the price you'd need to pay. So what's the final call? What does the analyst recommend? You know, this one sentence from the analysis really says it all. The investment case hinges on cyclical timing rather than long-term value creation. Let me translate that. CNH isn't one of those buy-and-forget stocks that grows steadily forever. Nope, this is a game of timing. You have to buy it when things look awful and sell it when everyone's optimistic. So, here's the bottom line. The final verdict is a hold. Right now, the stock is pretty much fairly valued. The analyst only recommends buying it if, and it's a big if, the price falls below $7.50. That's the only way you get that crucial margin of safety you need to make this whole thing worthwhile. So there you have it. The story on CNH is pretty clear. It's a classic cyclical stock. It's a waiting game that requires a ton of patience and buying at just the right moment. So what do you think? Is this a stock you've put on your watch list? Let me know. And hey, while you're at it, drop a comment and tell us which company you want us to break down next. Thanks for tuning in.